Are you considering building a house instead of buying an existing one? I mean, with home prices continuing to rise, you want a home that's right for you. So building a home might just feel like the perfect alternative. But before you take the leap, it's important to understand how building a home is so different, especially when it comes to the financing. As a top nationwide lender, I get this question a lot. So today, I'll walk you through the key financial differences and requirements for building a house so that you can decide if it's the right option for you. And stick around, because later in the video, I'm going to share essential financial tips to help you navigate the building process and avoid costly mistakes. When you buy a home, you typically need just one loan. It's a mortgage that covers the entire cost of the home. But when you're building a house, things get a bit more complicated. You'll need financing for the land, the labor, and the materials, which often means multiple loans throughout the process. For example, you might need a land loan to purchase the initial property, a construction loan to fund the build, and then a long-term mortgage for permanent financing once the house is complete. This is quite different from the straightforward and quick process of buying an existing home. Another big difference is the down payment. Unlike purchasing an existing home with as little as 3 to 5% down, construction loans typically require a higher down payment, similar to 20 to 25% of the total project costs, because lenders see construction loans as riskier than traditional mortgages. That's something that you'll need to plan for before starting the building process. Building a home involves 3 major financial steps. The first step is buying the land. Whether you're purchasing a vacant lot, a home that you're going to scrape, or a larger piece of acreage, you'll likely need a land loan, unless you're paying cash. And the good news is if you do end up owning the land outright, or if you have significant equity in it, you can use it as collateral towards your construction loan's down payment. The second is funding the construction. This is where a construction loan comes in. Construction loans are short-term in nature, typically 6 months to 18 months. And they're interest only during the building phase. These loans cover the labor and materials needed for the project, but they often don't include the cost of the land or ultimately the long-term financing. And then the final step is securing long-term financing. Once the house is complete, your construction loan will need to be refinanced into permanent mortgage financing. This step is essential for turning your new house into a long-term home. Getting a construction loan requires a bit more preparation on your end than applying for a traditional mortgage. First, you'll need to secure the land, then hire a builder or a contractor and finalize your house plans. Once those are in place, you can submit your application for a construction loan. The lender will review your financial information as well as your builder, the plans, and the budget. The bank will also order an appraisal. But of course, your home hasn't been built yet. So the appraisal will be based on your house plans, comparables to that house, and the value of the lot. Lenders typically require 20 to 25% down payment, which does reflect the higher risk of a construction loan. Once your loan is approved, you'll receive funding in phases, known as draws. These draws are tied to specific milestones in the construction process. You don't get all the money up front. For example, after the foundation is completed and inspected, the lender may release the first draw so that you can pay your contractors. This ensures the money is being used properly and helps keep the project on track. There are several types of construction loans, and choosing the right one depends on your specific needs. A one-time closed construction loan combines the construction financing and the permanent mortgage into one loan. Now, this loan saves you from having to close twice, but they can be a little bit harder to find and may come with higher interest rates. A two-time closed construction loan involves 2 separate loans, one for the construction and one for the permanent financing. Now, while this option gives you a little more flexibility, it also requires 2 qualifications and 2 closings, which means more paperwork for you and higher overall costs. And then there's a construction-only loan. This funds just the building process, and it leaves you to find the permanent financing on your own once the house is complete. Now, government-backed programs like conventional FHA, VA, and USDA loans do offer one-time close options for eligible borrowers. One of the biggest challenges of building a home is managing overlapping housing costs. I mean, think about it. While your new home is being built, you still need a place to live, which means that you'll likely continue paying rent or a mortgage on your current home. And this can add up quickly, so it is important to plan for these expenses ahead of time. You can also find unexpected costs are another common issue. I mean, even with the most experienced builders and the most detailed budgets, construction costs can often go over budget, often due to unforeseen problems. Lenders typically require borrowers to have reserves set aside to cover these extra costs. Finally, managing contractors and payment schedules can be tricky. Some contractors expect partial payments up front or at certain milestones. So it's essential to communicate clearly with your builder and align their expectations with your loan's draw schedule. To set yourself up for success, start by saving for the larger down payment required for construction loans. And if you already own the land, its value can often count towards your down payment, which can help you reduce your upfront costs. It's also important to have a contingency fund for unexpected expenses. Setting aside extra savings can help you avoid financial stress if something goes over budget. And lastly, make sure you understand how those interest-only payments work during the construction and factor them into your budget. Despite the challenges, building a home comes with some amazing benefits. First and foremost, you get to create a space that's uniquely yours. From the floor plan to the finishes, every detail is customized to your needs and preferences. New construction homes are also more energy efficient, and they come with modern appliances, which ultimately can save you money on utilities and maintenance over time. And if done strategically, building your home can help you build equity quickly, especially if property values in your area are rising. Building a home is a big decision, and while it comes with more complexity than buying an existing home, the rewards can be worth it. With proper planning and financial preparation, you can turn your dream home into a reality. If you'd like to dive deeper into any part of financing the building process, my team can support you with our one-time close conventional construction loan. Or if you need help finding the land, choosing a builder, or designing your floor plans, I have the real estate agent connections that can get you started on the right foot. Let me know in the comments below. I'm Nicole Rueth, your trusted mortgage advisor and real estate expert, helping you build wealth through home ownership, one smart decision at a time. And hey, don't forget to like, subscribe, and share this video with someone you know can use it. I'll see you in the next video.